Nexus warns there are signs of dysfunction in the bond market. Market forecaster Jim Bianco runs Bianco Research. What are you seeing, Jim? What concerns you?
Well, what happened in the UK yesterday? I mean, if you go with their announcement straight up, they said that there was a financial stability concern. And, to put it in alarming terms, somebody was ready to fail. And they had to force the price of gilts, that's their government bond, much higher so that their mark to market would not create the problems that we want. Remember, the bond market is always bought with a lot of leverage. We call it repo. And when the prices fall as much as we've seen this year in all markets, and particularly in the last week or two in the UK, there is going to be a lot of stress in markets. And there is in the bond market in the UK and everywhere else.
In the UK that's a real unique case in terms of the declines that we've seen in that bond market in such a short amount of time, Jim. And I'm wondering, when you say somebody could have failed or somebody might be on the brink of failing, intervention is only for a certain amount of time, and then who knows what the markets will bear after that. Is there still that chance that instability rears its ugly head, and is there a transmission mechanism to here?
Yeah, I think what it is, you're right. You could call it a stay of execution. That's what we did yesterday, but we haven't solved the problem. The problem is still rising rates, falling bond prices, financial firms that own it with leverage. And remember, in the UK, pension plans also can use leverage in the bond market too. So they're having a lot of problems in terms of meeting collateral requirements. That's posting more money. It's a margin call is what that is. And so we're not over this problem. What gets us over this problem is signs that inflation is coming down, or signs that the Truss Prime Minister of the UK is going to back off of her tax cuts and extra borrowing, which has really rocked the market. But neither one of those is happening right now. In fact, Truss came out and reiterated that she wants to move forward with her tax cuts earlier today.
Jim, we've been talking about bond market volatility literally for the last 18 months. What changed? I know you've been mentioning it, but you're actually now mentioning it in earnest now. Was it the Bank of England thing, or did something fundamentally change over the last 48 hours?
I think something might have fundamentally changed over the last 14 hours or 48 hours, because what you saw with the Bank of England is now we have a tangible sign that there is real dysfunction in the market. I've always suspected that the market has had, and I'm talking about the bond market, has had that dysfunction, and we're not going away. But what really kicked it all off was the surging dollar. And I would agree with Tim, if that is peaking and backing off, that would be a big sigh of relief. But if the dollar continues to surge from here, it's going to create just more havoc, because the answer to a surging dollar for a lot of these countries is much higher interest rates. And that's the one thing that they can't afford to have right now.
Jim, it's Karen. Thanks for being on. Do you think any of this is part of the Fed tightening, the QT?
Yes. Let's go back a week ago. The chairman of the Federal Reserve, Jay Powell, said that all rates, in fact, Loretta Mester said it, you mentioned it earlier, all rates should be positive. They should be above, real rates should be positive. They should be above the inflation rate. He then went on and said what inflation rate he's talking about, core PCE. That is estimated by September to be at 4.8%. He wants rates, all rates, up in the upper fours, from the 3-month bill to the 30-year bond. So I think what markets saw out of his press conference last week is he thinks rates have to go a lot higher. And then you saw the effect around bond markets around the world. Remember, all bond markets trade on spreads. So if the U.S. markets, which is the dominant market, is going up, it's dragging everybody else up. And if the U.S. is going up and that causes the dollar to surge, the only way you could stop your currency from crumbling is to offer an unbelievably high interest rate, which puts you in stress like we saw with the UK.
So let me just follow up on that. I was meaning just the sales from the balance sheet, not the Fed funds rate, in terms of just the technical, seller on the market.
The Fed is, to be technical about it, the Fed is not a seller in the marketplace right now. What they're doing is they're letting bonds mature, and then they're buying less, and they're letting their balance sheet reduce. The Bank of England actually would be a seller when they announced QT last week, which they reversed yesterday. But nevertheless, that is a bunch of bonds, $90 billion worth of bonds a month that somebody's going to have to buy that the Fed used to buy. So there's a bigger crowding out in the bond market because of the supply with QT. So even though they're not selling, we got to find me a $90 billion a month buyer to kind of offset what the Fed was doing just a few months ago.
Jim, great to speak with you. Thank you. Jim Bianco, Bianco Research. Tim, what do you